What's going on YouTube? It's Ganimo and welcome back to our channel. In today's video, we're going to be giving you 5 reasons why you should be investing in index funds. And we're going to dive right into it. So let's get started.
So when my wife calls me boring, I make it a point to prove her wrong. However, when my colleagues call me a boring investor, I wear it like a badge of honor. I can't usually partake in most of the conversation about what's the hottest stock to buy because I really truly don't care to. And the true reason I don't care to is because I'm an index investor. I don't believe in picking stocks. I don't believe in chasing the hottest fad. I believe in the tried and true method of just trying to capture the market returns.
So as said, why be boring and start investing in these index funds? Well, first of all, buying stocks or bonds introduces uncompensated risk, i.e. risk that you aren't adequately compensated for.
So let me explain. Anytime that you're purchasing a company through purchasing their stocks, you're introducing unnecessary risk into your investing. So a company could have a bad quarter, a bad year, or actually go bankrupt. That happened in the past. That happened in the 2000s with the dot-com bubble, happened to Enron, one of the largest companies in the world, and even today with the pandemic going on, how many companies are actually going to be coming back to business? Would you have ever thought that Neiman would go bankrupt or Hertz?
And our way around all of this is by investing in index funds, which decreases our uncompensated risk, provides us with broad diversification, daily liquidity, and professional management, all for a very low cost.
Another great reason to invest in index funds is because it's a passive investment with a great track record of better performance at a very low risk. So the data is very clear. Active management over the long run cannot beat passive management. And why is that? History has shown that the active management cannot overcome the costs associated with them over the long run.
Historically speaking, over the course of 10 years, an index fund will outperform 80% plus of its peers. So, if you stretch that over the long term, call it 30 years by the time you're ready to retire, and you gather all your asset classes, that index fund will outperform 99% of other actively managed portfolios. So what does that mean for you? Well, that index fund will provide you with higher returns than those who pick individual stocks or mutual bonds.
So when you invest in active management, or if you have a money manager, you might be asking yourself, is the recent underperformance of my portfolio due to that money manager's lack of luck? Or do they lose the skills needed to get me the best returns possible? So these money managers are humans, just like you, I, or Gan. So they're no better at picking the stock market or finding out what is the best performing hot fad, and they definitely don't have a crystal ball that's going to predict how to invest for the future. And that's why we typically don't recommend for you to be parking your money with those money managers, and instead you should be investing in index funds and accepting the market returns.
Another benefit to investing in index funds is that it's much less time consuming, especially for all those healthcare providers that don't have much time to start doing the research and following the companies and waking up at 4:30 in the morning and looking at the futures on Fox Business News. Instead, with that spare time, you'll be watching reruns of The Sopranos or The Bachelorette like Mo over here. Remember, we invest to live. We don't live to invest.
So to put that into perspective, I spend about 30 minutes a month to manage my portfolio. And that's a grand total of 6 hours a year. And I use that time for additional contributions, to manage my asset allocations, and to rebalance my portfolio. So even if you're one of the lucky few who actually manages to beat the market in a given year, whenever you factor in the amount of time lost researching that stock, buying in and out of that stock, trying to figure out everything about how to time the market, you are going to end up coming out losing because your time is money, especially as a healthcare professional.
Another big plus to investing in index funds is that they're associated with lower costs. Their expense ratios are about 1/10 of those of actively managed funds. That's 0.02% to 0.2% versus 0.5% to 2% of actively managed funds. And on the back end, there's some hidden fees that you don't see. How do you think all those Wall Street guys are driving their Mercedes to their penthouse in Central Park? Well, guess who has to pay for that? You do, Mr. Actively Managed Investor, but not for those with a passively managed portfolio who are investing in index funds.
Now, the best part about investing in index funds is that it guarantees me the market returns. So if the market is up 8% for the year, that means that I'm up 8% for the year. If it's up 1% for the day, I'm up 1% for the day. And that's the beauty of it. If the S&P 500 is up, my indexes will be tracking that S&P 500. And that's why I'll be up. Same thing goes if my markets are down. I will be tracking that market. But the good thing is that I am always guaranteed the market returns. Now, beating the market is very tough. And the ones that do try to beat it typically fail, and they fail big. And the ones that do manage to beat it end up succeeding very minimally. It's almost not impactful. Now, if you ask me the question, how can I capture the market return? Well, that's easy. Invest in index funds.
Now, that all being said, there are many ways to invest, and we're not financial advisors, but do yourself a favor. If you're investing in stocks and bonds, that's great. Do the due diligence and do the research. But try to keep a portion of your investment in index funds. It's going to pay off in the long run. Do you like to invest in index funds, or do you stick to individual stocks and bonds? And as always, don't forget to gingerly tap that like button. Don't forget to hit subscribe, and we'll see you next time.